Bitcoin mining. This ain't your daddy's gold rush. This is a new decentralized frontier filled with nonsense, hashing algorithms, and the mythical ASIC chip. Today, we're going down the rabbit hole to find out the secret behind...
Okay, for real though, what is the point of all of this? Endless arrays of computers churning out random numbers in far out locations? And why are billions of dollars of institutional capital flowing into this? Why not just invest in Bitcoin itself? In this video, we're going to dive into the 5 largest publicly traded Bitcoin and cryptocurrency miners and see what all the fuss is about, what makes each one of these companies different, what their specialty is, and whether or not you should diversify some of your cryptocurrency holdings into these mining stocks themselves. To understand the business of Bitcoin mining, we need to see what exactly is happening there in the first place. Think of the Bitcoin blockchain as essentially one big, ever-expanding record book of every transaction that has ever taken place since its inception in 2009. Each page in this book can only hold so many transactions before the page gets full, and a new page is then necessary. Since so many transactions are coming into this book at any given time, there has to be a method to add each new page to them incrementally and fairly so that we know every page is linked to the previous. Thus, in order to generate a new page of records, you have to solve for a numeric puzzle called a nonce. And if you find that nonce or string of numbers and letters, then and only then does the new page or block get added to the blockchain or the book. So in addition to this, for solving the challenge, the finder of the nonce is rewarded in Bitcoins. Now, here's the thing. This nonce or numeric puzzle could be as simple as a key combination to a lock, or as difficult as trying to find one particular grain of sand in the Sahara Desert. Since the Bitcoin network is growing exponentially, in order to keep the new blocks and transactions flowing, the network automatically adjusts the difficulty of finding this nonce, or mining, every 2 weeks. In the first year of Bitcoin's life, you could mine profitably and successfully right from your old laptop. Now, in order to mine at scale, people are building massive warehouses full of ASIC miners that run directly and indefinitely off of solar, geothermal, or hydroelectric renewable energy. If you want to mine Bitcoin for a living, it's not going to be easy, but do it correctly and with a bit of ingenuity, and it's extremely profitable. Because not only does it give you access to an asset that has historically gone up 150% a year, but it's giving you the ability to generate that asset at 50 to 80% cheaper than the actual market value. But let's just say that you don't have a ton of capital to buy a shipping container full of supercomputers and run it off of a raging waterfall. That's where Bitcoin mining stocks come in, and there's a lot to choose from. The 21 million Bitcoin question is it better to own the miner than the Bitcoin? And if so, which one is the best bang for your buck? One of the biggest challenges of being a Bitcoin miner is that it's extremely capital intensive. As the hash rate for Bitcoin grows exponentially over long periods of time, miners constantly need to shell out cash for new and faster performing machines to keep up with their competition. However, one of the most interesting developments in the world of cryptocurrency mining has been the exodus of miners from China. In June 2021, China kicked all cryptocurrency miners out of the country, citing energy usage concerns, and probably something to do with protecting their own currency. Within a week, over 50% of all hashing power on the Bitcoin network fell. And while this doesn't actually impact the speed of the Bitcoin network, it creates a dramatic drop in difficulty for all of the other miners that are still on the network, giving them a much larger slice of the mining revenue from mined blocks. Outside China, the largest miners in the Bitcoin space are in North America, and a lot of these are publicly listed companies, the biggest of which are RIOT Blockchain, Marathon Digital, Bitfarms, HUD8, and HIVE Blockchain. Compared to the price of Bitcoin, these stocks have done incredibly well, but it all depends on what your starting point is. If you're measuring from 2020, they've well outperformed the price of Bitcoin. But go further back, and their extreme drawdowns and correlation of Bitcoin's bear markets, as well as all the dilution that some of these have gone through, have actually positioned them off a lot worse. Under the hood, each one of these companies, despite having a similar business model, have drastically different histories of operations. Some were shell companies and pump and dump penny stocks for years. Some don't sell any of their mined Bitcoin whatsoever. If you're enjoying this video so far and you want to see more content just like this, I do a live show every single week where I go over the biggest news in the cryptocurrency and finance market space. And all you have to do to see that is subscribe down below to the Kinetic Finance channel and switch the notification bell icon to all notifications. This way you're reminded every single time I go live. You can tune in or you can watch the videos later, and it really helps support the channel and also gives you a voice in seeing what type of content you want to see me cover in the future as well. Now back to the video. RIOT blockchain was incorporated in July 2000 and only recently renamed to RIOT blockchain in October 2017. Almost all of RIOT's mining facilities are located in Messina, New York, under a lease with CoinMint, and they're strictly focused on mining Bitcoin. RIOT has been rapidly expanding their mining capacity, currently estimated around 2.3 exahash per second, with a purchase agreement for 43,000 Antminer S19Js expected to be deployed by 2022 that will triple their current output. The only issue is almost all of this expansion has been at the expense of shareholders in the public market, where they've raised over $200 million in the last year whilst increasing their floating share count by almost 40%. The problem with that is that they're essentially using all of their capital to purchase a rapidly depreciating asset, a loud application-specific chipset that again is generally rendered obsolete within 2 years. Unlike a few other companies on this list that are much smaller in terms of hash rate and market capitalization, RIOT only holds $69 million worth of Bitcoin in the reserves, despite being projected to have over $500 million of revenue this year. RIOT also has a bit of a shady history. It was one of the famous companies back in 2017 that became a blockchain company out of nowhere. Its former CEO settled with the SEC for unrelated charges involved in pump and dump schemes and market manipulation. Their mining facilities are also co-leased and operated by another company called CoinMint, which was the center of a failed dissolution bid from one of its co-founders, which threatened to liquidate the company. They're also not famous for having a stellar track record in capital allocation as well, reporting to occasionally pay far above MSRP for their mining hardware from third parties in the event that inventory from Bitmain, the leading chipset manufacturer, would not be available. RIOT might be one of the biggest miners that you can buy on the market, but they have a much higher degree of downside potential, in my opinion, than other better capitalized miners in the space, with a hefty premium in valuation that I think is mostly due to name recognition and having first mover advantage as a publicly listed miner. So while I don't think that makes them a solid investment, they are still a very good instrument for trading. With lots of correlation to the price of Bitcoin and the most liquid options chain of all of the Bitcoin miners, trade it, don't own it. Marathon Digital Holdings is also a behemoth-sized miner in the Bitcoin space. Incorporated in 2010, the company was first a mineral exploration company.
You have a rock collection? It's a mineral collection.
Then in June of 2012, it discontinued its mineral business and became a real estate investment firm in Southern California. And then only 4 months later, in October 2012, it ditched real estate and became an IP licensing operation or patent troll. Rest assured, it wasn't until the absolute pinnacle top of the 2017 crypto boom when Marathon finally rebranded to what it is today. Marathon Digital Holdings, finally finding its groove as one of the largest Bitcoin miners in North America. Very similar to RIOT, Mara has been on a spending spree to acquire as many Antminer S19s as possible and deploy them at the cheapest energy producing sites across the continent. Comparatively, Mara expects to have 133,000 miners at 13.3 exahashes at the end of 2021 versus RIOT at 81,000 miners around 7.7 exahashes by the end of 2022. Which means in terms of speed and scope, Mara is set to have a full year of mining dominance over RIOT. And as we know with the difficulty curve on the Bitcoin hash rate, timing is everything. Like RIOT, Mara has also diluted heavily through secondary offerings to raise the capital funds necessary to purchase these new miners. But one of the more unique aspects is that they actually raised a $300 million offering and used half of the proceeds to straight up buy Bitcoin, of which they now hold around 0.03% of the entire supply of. Given that at the time of this recording, both Mara and RIOT have the same market capitalization, it does look like Mara is the better deal here. But as with all of these companies, leadership is going to be the key differentiator that determines the relative performance to Bitcoin over the long run. One of Mara's recent controversies is that it started a mining pool to mine OFAC compliant Bitcoin. And that basically just means that they would not process any transactions from addresses specifically listed on the US Department of Treasury's designated nationals and blocked persons list. This was an attempt to come off as a clean miner, not accepting transactions from malicious actors or sanctioned countries. But it completely went against the ethos of Bitcoin as an attempt to suck up to regulators by censoring Bitcoin transactions. And only to undermine how silly and impractical this approach was, Mara even ended up processing a Russian dark web market transaction in its compliant mining pool, showing the fruitlessness of trying to pick and choose what transactions to mine in the Bitcoin network. Within only 4 days, Marathon CEO Fred Thiel backtracked the entire initiative and they announced that they wouldn't censor transactions anymore. Despite some questionable management in the past and present, Mara has seen some of the most institutional support out of any of the publicly traded miners. Fidelity, one of the largest financial services companies in the world, took a 7.4% stake in the miner just recently. With Mara, you're getting the same baggage as RIOT in some ways, but for a bit better bang for your buck. Bitfarms, or BITF, stands currently at around 1/3 of the market cap of RIOT or Mara, but arguably hosts a much more impressive resume. In fact, in comparison, Bitfarms has actually mined more Bitcoin than either of them this year. Bitfarms is primarily located in Canada and uses 99% green hydroelectricity to power its mining centers. So if you're worried about the environment or have an ESG mandate, fret no more. Like the other public miners, Bitfarms is also set to acquire a lot more mining capacity over the next few months, raising its mining fleet to 8 exahashes by the end of 2022. What makes Bitfarms stand out from competitors is the structure of the company as well. Bitfarms has their own electrical contracting company and on-site hardware engineers that install, maintain, and repair their own miners, keeping their operation costs a lot lower than some of the other miners which are known to contract out their operations. They also don't source out their mining rigs from Bitmain, but from a company called MicroBT, and they've been able to negotiate substantial price reductions on hardware purchase agreements from that partnership as well. So what's the catch? Why is BITF trading at such a reduced valuation compared to Mara and RIOT? Well, it's really hard to answer that question, but if I was to take a guess, I think a large part of it has to do with the brand awareness of the stock. While RIOT's market cap is only about 3 times the size of BITF, on average, RIOT trades 10 times more dollar volume on the NASDAQ on a daily basis. Volume represents retail and institutional awareness, and on a relative basis, any stock with excess regular volume is most likely going to trade at a higher price to an equivalently valued stock. If you're looking for value above all else, I'd say that BITF has the best bang for your buck, but that doesn't necessarily guarantee that it outperforms RIOT or Mara in the long run. It just means that on a per Bitcoin mined basis, the premium that you're paying for this mining company is a lot better. HIVE blockchain is a diversified mining company, not only involved in mining Bitcoin, but also Ethereum. In fact, they are the only publicly traded company that mines Ethereum. But before we dive into that, let's talk Bitcoin. HIVE is on target to hit 1 exahash of Bitcoin mining hash rate by the end of this year, which puts it quite a bit behind most other publicly traded miners. Its mining operations, similar to Bitfarms, are also almost entirely green, located across the world in Canada, Sweden, and Iceland. And unlike almost every other miner on this list, HIVE is the only company that is essentially debt-free all the way from 2020, boasting a significant amount of cash flow from its standard operations to pay for future expansions. The massive differentiating factor for HIVE over the other miners is that Ethereum arguably makes up more of its net revenue than Bitcoin mining. The firm mined around 71,000 Ethereum in 2020 versus around 2,000 Bitcoin. And due to Ethereum's relative outperformance over Bitcoin, that means that the dollar value of their mined ETH is worth about twice as much as their Bitcoin. The challenge with this moving forward, however, is 2 things. One is that ETH mining economics are a lot different than Bitcoin mining. When you mine Bitcoin or Ethereum and you successfully find a block, you're rewarded with 2 things: the block reward, which is set at a fixed rate, and a transaction fee. For Bitcoin, the transaction fee is a much less relevant part. Almost 99.9% of miner revenue is made from the block reward. For Ethereum, however, blocks are mined at a much faster rate, and transaction fees play a much more complex and larger role in the mining process. Over half of all ETH miner revenue nowadays comes from transaction fees, and these have been growing exponentially in sync with Ethereum's user growth and the rise of things like NFTs. But within the next 2 years, Ethereum is set to transition away from proof of work entirely, rendering almost all mining equipment dedicated to its network useless. There will still be an economic incentive to validate fees, but in the new network protocol proof of stake, it'll be a lot more based on how much ETH you stake rather than how much hash power you have. HIVE is aware of this dynamic and as such has held a significant portion of its Ethereum in long-term cold wallets. The question is, will this move to proof of stake hinder HIVE blockchain or will it help it? In my opinion, they're likely going to transition their mining operations for ETH to another cryptocurrency that still uses proof of work, rather than get rid of them or mark them down entirely. The biggest factor for HIVE will then be how to justify a higher valuation than today relative to its peers. A business that doesn't take on debt to expand might seem more prudent, but the market has rewarded debt issuance more often than not, while interest rates stay around 0 to 1%. If you're also not a firm believer in the continued exponential growth of the Ethereum network, HIVE also isn't a pure play on Bitcoin like the others as well. HIVE is definitely a more complicated stock that warrants a closer dive into the unit economics of its own mining operations, the investigation into the future of Ethereum miners and stakers, and what role it can expand upon in the future of decentralized finance. HUT8 Mining is another Bitcoin miner with equivalent market cap to BITF and HIVE, with projections for around 5 exahashes of mining hash rate by the end of the year. Almost all of HUT's mining operations are in Alberta, utilizing wind, solar, and natural gas to power their own fleet of ASICs. Similar to BITF and HIVE, it also trades at a relative discount compared to RIOT and Mara, and a market cap basis based on hash rate. HUT8 is also one of the biggest hodlers of Bitcoin amongst the public miners, coming in second to Mara, holding slightly over 4,000 BTC, almost all of which are self-mined. Dig into the numbers though, and much of HUT's performance has been lackluster. Out of the last 13 reported quarters, only 3 have been profitable in revenue for HUT8. And in terms of dollar revenue, while they just reported their best revenue ever at $30 million for Q2 2021, that's barely higher than their Q2 revenue 2 years ago in 2019. HUT8 has diversified a bit of their income by lending out 1,000 of their Bitcoin to Galaxy Digital and Genesis Mining at around 4% annually, and also by renting out some of their facilities and infrastructure to other miners. But while that has helped them cut costs, it hasn't really helped them scale up to the challenge of other miners eating a bigger slice of their pie. While their long-term holding of Bitcoin may help their balance sheet, if appreciation in the public market is what you're after, HUT8 has barely outperformed the appreciation of Bitcoin since the bottom of the 2018 bear market. There just isn't enough here that makes HUT8 a better choice over the other miners on this list. In every metric, from Bitcoin held in mine to hash power to earnings per share or any other factor, there is nothing that HUT8 objectively outperforms on relative to its peers. The other publicly listed miners are like the McDonald's, A&Ws, and In-N-Outs of the fast food industry. HUT8 is like your local mini mall Arby's. Bitcoin mining is an industry in the world of cryptocurrency that won't be going away anytime soon. But when it comes to options on the public market, these companies are basically all the same. They have no moat, no IP, and little to no diversification outside their mining operations. What you are paying for is a management company that has access to capital markets to purchase as many mining units as possible, as quickly as possible, to run them as cheaply as possible. Moreover, if you believe that Bitcoin will continue to expand and grow exponentially from where it is today, you have to be willing to consider that other energy companies will also get involved in this space. Whether it's capturing methane flares or using extra energy produced at a dam site, if Bitcoin hits 100K or 200K at any point, it'll become increasingly obvious for any energy production company to diversify and also capitalize their own mining operations. After all, it's a lot more profitable to mine Bitcoin even during a bear market than it is to sell excess electricity directly to the grid. That's not to say that any of these companies are outright bad investments, but timing is absolutely key to picking your entry on any one of these. And while they might be at their cheapest during Bitcoin bear markets, they're also at their most exposed in terms of bankruptcy risk. If I was forced to throw my money at one of these 5 miners, I'd likely go with Bitfarms or BITF, as their capacity is on par with the biggest miners, whilst also still trading at a significant discount and with much better management on board. But yeah, that's my take on it. As always, do your own due diligence and let me know in the comments down below. Are you invested in any of these names? And if so, what made you take the plunge? If you liked this video, you learned something today, don't forget to give it a like down below and subscribe for more content in the world of crypto and finance on a regular basis. I also do a live show every Friday around 1 p.m. Pacific, 4 p.m. Eastern, covering all of the biggest stories of the week as well. So make sure you check that out if you want more regular content just like this video. Thanks so much for watching, take care, and remember, don't forget to hodl.